guys, in this learning unit, we are going to cover the elimination of intercompany transactions and balances. So what exactly is the elimination of intercompany transactions and balances? Before we jump into the accounting jargon of it, let's take a step back to really understand this from a practical point of view. So I want you to picture this for me. So I want you to picture a married couple, right? So here we have a handsome stick man by the name of Rudy and his lovely wife named Julia. So they both are married, and there's their nice little household. Now let's say at some point Rudy loaned Julia 1,000 rand. So Rudy he loaned the money to Julia, and Julia owes 1,000 rand now to Rudy. And then later down the line, this couple wants to apply for a bond. So they approach the bank. So externally, you have now a bank. So when they apply to the bank is not really going to consider the individual profiles of the income and expenses of this couple. They're going to consider what is it that the household makes. So both of them combined. But when you think about it, Rudy can't go to the bank and say, you know what, I have actually a loan receivable. But meanwhile, his wife has a loan payable. So the net effect is null. The bank is not interested in the transactions between each other. The bank is interested in terms of the income going into the house and the expenses going out of the house. Anything else between Julia and Rudy, whatever happens between them, is not regarded, it's disregarded. Well, this concept actually is the exact same for elimination of intergroup transactions. Now, I want you now to relate it to the accounting side. Now, on the accounting side, we're going to have, let's say, entity A. And entity A is a lot like Rudy, where let's say it's a parent, it'll be known as the parent, or the holding company. And then we have entity B, representing Julia, who is known as the subsidiary. And much like there's a relationship between Rudy and Julia, there needs to be a relationship between these two companies. In this case, for accounting, there needs to be an element of control, where let's say entity A owns controlling share interest in the entity B, so that forms a relationship. Now, we know that when there's a relationship, much like this couple, it creates a household. This household is known as a group. And well, what does the bank represent compared to that in this picture? The bank itself is external stakeholders. So what are external stakeholders interested in? They're not interested in the individual books. They're interested in what goes into the group and what comes out of the group. They're interested in the group figures, the consolidated figures. So naturally, what we need to then do is, any transaction that occurs between the two entities needs to be removed. Because when you have a transaction with yourself, if you have a loan receivable and you add in the two books to give you one household income, to give you the group consolidated figures, in essence, you are telling the external stakeholders, my loan receivable is 1,000 rand and your loan payable is 1,000 rand. It's inflated because it's a transaction with yourself, because you look at it as a group entity and not the individuals. So therefore, the reason why we have this learning unit, elimination of intercompany transactions and balances, we need to take out and remove transactions between the two entities, regardless of the direction, because this inflates the figures in our consolidated statements, and we're interested in compiling and reporting on these consolidated statements. And any profits as well that arises between these entities is deemed as profits made from ourselves, which we need to then remove from these books. And that's why you have the elimination of intercompany journals.